How the Iran-Israel conflict is fueling a global oil price surge, with a custom intro for your channel RV News, all written in paragraph format without headings. Welcome back to RV News, your trusted source for global financial shifts, currency updates, and real-time geopolitical developments that impact your future. If you're watching this, you already know that staying ahead of major world events is the key to understanding how markets shift and when opportunities arise. Today, we're diving deep into one of the most urgent and explosive situations unfolding right now on the global stage: the escalating conflict between Iran and Israel, and how this confrontation is fueling a dramatic surge in global oil prices. From the Strait of Hormuz to Wall Street, the ripple effects are undeniable. And whether you're holding foreign currency, investing in energy, or simply filling up your tank, this affects you directly. So let's get into what's happening, why it matters, and what could be coming next. In the past few weeks, tensions between Iran and Israel have reached a fever pitch. Long-standing hostilities have evolved into active confrontation, with strikes, counterstrikes, and proxy skirmishes that threaten to expand into a broader regional conflict. These are not just isolated events anymore. They are beginning to form a pattern that has deep and immediate consequences for global markets, especially oil. Iran, a major oil producer with strategic control over the Strait of Hormuz, through which nearly 20% of global oil passes, is at the center of the storm. Israel, a key Western ally, is facing increased threats from Iranian-backed forces, not only in Gaza and Lebanon but potentially on multiple fronts. Each military action taken by either side sends shockwaves through the energy markets, triggering speculation, fear, and volatility. As this situation intensifies, oil traders and financial analysts around the world are watching closely. Just 1 week ago, crude oil prices were hovering around $82 per barrel. But as the latest round of military escalations unfolded, including airstrikes, naval posturing, and the mobilization of Iranian Revolutionary Guard units, prices spiked, crossing the $95 per barrel mark for Brent crude, and continuing to rise. This is not just market noise. This is a reaction to the real and perceived threats to oil supply, especially from the Gulf region. And while some may argue this is just another short-term price hike, the undercurrents suggest a more sustained and structural risk to energy supply that could push prices well beyond the $100 threshold. What's important to understand is that oil pricing is not just about supply and demand. It's also about perceived geopolitical risk. When risk goes up, so do prices. Traders begin to hedge, insurance rates for shipping spike, and countries start scrambling to secure their reserves. Iran, knowing this, has historically used the oil market as a strategic tool. When pressure mounts, Tehran often makes thinly veiled threats to close or disrupt the Strait of Hormuz, a move that would immediately choke off nearly a fifth of the world's oil supply. Even the threat of such an action is enough to rattle markets. In the current context, with Iranian naval exercises taking place dangerously close to shipping routes and Western tankers being harassed, the risk is not just theoretical. It's alarmingly real. Meanwhile, Israel, backed by its Western allies, including the US and the UK, is increasing its military presence and retaliatory capacity. The U.S. Navy has already deployed multiple carrier strike groups to the region in anticipation of potential escalations. Washington knows that any interruption in oil flow from the Gulf could destabilize not just local markets, but the entire global economy. And this is exactly what's happening. As military activity intensifies, insurance premiums for oil tankers have tripled, making it more expensive and riskier to transport oil from the Persian Gulf to global destinations. That cost gets passed on to governments, to refineries, and ultimately to you at the pump. This new wave of tension is not limited to Iran and Israel themselves. It is drawing in other players from the region and beyond. Saudi Arabia, Iraq, the UAE, and even Turkey are carefully watching developments, with some issuing diplomatic warnings and others preparing contingency plans. The concern is that if this conflict spreads, even slightly, we could see a cascade effect where neighboring countries are forced to take sides, either due to political alignment or economic necessity. This would not only deepen the conflict, but would also threaten infrastructure, refineries, pipelines, and key maritime routes, all of which are essential to the global oil supply chain. Let's not forget the historical precedents. Every major conflict in the Middle East over the past 50 years, from the Yom Kippur War in 1973 to the Iraq War in 2003, has caused significant disruption to oil supply and massive spikes in oil prices. And each time, those price spikes have had ripple effects across the globe. Inflation, recession fears, market collapses, and shifts in monetary policy. Today's situation is eerily reminiscent of those past crises, but with a twist. The global economy is already fragile due to the post-pandemic recovery, ongoing inflationary pressures, and international debt crises. An oil shock now could be the tipping point for many economies that are already on the edge. The International Energy Agency, IEA, and the U.S. Energy Information Administration, EIA, have both issued statements warning of potential supply disruptions. Both organizations are urging nations to prepare for strategic reserve releases, which tells us that they expect real supply issues, not just speculative volatility. The U.S., which still holds over 350 million barrels in its strategic petroleum reserve, may have to tap into those reserves again if prices climb much further. But that's a short-term fix. The bigger question is, what happens if this conflict turns into a prolonged standoff or a full-scale war? In that case, we are likely to see sustained oil prices well above $120 per barrel, possibly even reaching $150, depending on how deeply production and transport are affected. That level of pricing would reignite inflation fears around the globe. Central banks, which were just starting to consider rate cuts, may be forced to reverse course. Higher oil prices mean higher transportation costs, increased production costs for goods, and ultimately, higher consumer prices. For those holding currencies like the Iraqi Dinar or the Vietnamese Dong, which many of you follow closely, this kind of global volatility could impact not only exchange rates but also revaluation timelines and strategic shifts by central banks in those countries. The financial implications are enormous. Already energy stocks are surging. Oil futures are being snapped up at record levels. Hedge funds are repositioning their portfolios to brace for a potential energy crunch. And countries that rely heavily on imported oil, like India, Japan, and several EU nations, are scrambling to secure long-term contracts to shield themselves from future supply disruptions. In other words, the world is reacting, and fast. But for everyday consumers and retail investors, the signals are more mixed. Gasoline prices are climbing steadily, and in some countries, diesel and aviation fuel are already experiencing shortages or rationing fears. What does this mean for you? Whether you're an investor, a traveler, or simply trying to manage your household budget, the Iran-Israel conflict is going to impact your life in real terms. If you're invested in oil, gas, or energy ETFs, you might see short-term gains, but with high volatility. If you're trading currency, this geopolitical risk might push safe haven currencies like the US dollar or the Swiss franc higher, while emerging market currencies could suffer. Gold and silver are also climbing as traditional stores of value during geopolitical instability. If you're watching the dinar and dong, keep in mind that this kind of global uncertainty can sometimes accelerate monetary policy changes, but it can also cause delays depending on how exposed a country is to energy price volatility. And then there's the humanitarian aspect. Conflicts like these are devastating on the ground, not just for the soldiers involved, but for innocent civilians caught in the crossfire. Refugee flows, economic instability, and infrastructure collapse could further deepen the crisis, placing even more pressure on oil-dependent economies. Already, NGOs and international agencies are warning of the potential for mass displacement if the conflict escalates into neighboring territories. The strain on governments to balance both humanitarian and economic needs will be immense. Looking ahead, the next few weeks will be critical. If diplomatic solutions fail and the military situation continues to spiral, we are likely entering a phase of prolonged energy insecurity. Watch for key signals: announcements from OPEC+, potential shutdowns of Iranian oil exports, missile attacks on infrastructure, or sudden changes in tanker movements through the Gulf. All of these will serve as indicators of how serious the disruption may become. And as always, follow the central banks. They will respond to oil-driven inflation pressures quickly and decisively. So here's the big takeaway. The Iran-Israel conflict is not just a regional issue, it's a global economic flashpoint. Oil prices are already climbing sharply, and the situation is fluid. We are entering a new era where geopolitical risk is once again a primary driver of market behavior. As viewers of RV News, you know we always emphasize the importance of staying informed. Thinking as